Good morning, everyone. Thank you for taking the time to join us for this combined Accurium BGL session, obviously titled ECPI and how to get it right and what can go wrong. Firstly, we like to start with a bit of housekeeping. Firstly, we like to mention to everyone that people do experience sound issues. So therefore, we do encourage people to use the phone option versus your computer audio, as it gives you a better quality and consistency of sound. Secondly, just a reminder for the materials today in your handout section. If you just pop the box out, you'll see the handout material for today's session, and they will also be available on the website after the event. What we do also just like to let you know, Matt, if you could go to the next slide for Slido. So during the session at Accurium, we use Slido for our questions. So please feel free to scan the QR code or go to slido.com and enter that access code in, and feel free to enter your questions during the session. And Matt and Anthony will possibly answer them during the session or at the end. We also like to just make an announcement about our SMSF Association. So obviously SMSF Association, we're sort of a proud educator, a sort of accredited educator through them. So they are the peak body for the SMSF industry. If you do need any more information on them, please feel free to phone them, go to the website, or obviously send them an email. We actually have 2 courses that if you participate through Accurium, you'll actually get free complimentary memberships with the SMSF Association until the 31st of March, 2025. So what I would say now is that concludes housekeeping. So what I'd like to do is introduce to you both our speakers today. So I'll start with Matthew Richardson, who is our SMSF manager at Accurium, and he has extensive knowledge in superannuation and self-managed superannuation funds. He is a qualified CPA and SMSF specialist advisor. He has worked for Accurium now for over 10 years, providing actuarial certificates and technical assistance to Accurium's large client database of accountants and SMSF practitioners. We also have our guest speaker today, Anthony Fernandez, who's actually from BGL. And Anthony's a dedicated team member of BGL since 2006. He brings wealth and expertise as a qualified CPA and accredited SMSF specialist advisor. He has a strong technical background and a relentless focus on client success. He's passionate about delivering SMSF compliant cloud software that empowers professionals to efficiently meet all the compliance needs for their clients. So thank you for both of you today, and over to you. Matt, we can't see you, but we're assuming you are there. Yes, there you are. Over to you.
Great, thank you, Chantel. Good morning, Anthony, and thank you to everyone else for joining us today. So yes, as Chantel said, today we're looking at ECPI, how to get it right and what can go wrong. So we're going to have essentially 3 parts to our presentation today. Firstly, it is just going to be a quick review of ECPI. I'm sure those of you who have come to any of our ECPI sessions before, that would be familiar to you. But we do like to start off with that. We do think it's a great place to start for these types of presentations. And secondly, we will take a look at some, certainly going into some common issues, in this case of failing the minimum pension requirements. We do see that a reasonable amount for clients, and they do have questions on that. So we'll run through what happens there, and that's especially in light of the update to tax ruling 2013-5. And that will be it for me. I'll cover those first 2 sessions. And then finally, Anthony will take us through a live demonstration and just take a look at a few other, I believe, reports in Simple Fund 360 that can help you with your ECPI. So, on to our review of ECPI. So, as we all know, our ECPI, exempt current pension income, reduces the fund's assessable income, reducing the amount of tax it would otherwise have to pay for the year. Now, of course, this is only applicable to funds which have a retirement phase income stream and have met the pension standards. But for those funds, it does apply to all of the assessable income during the year, including capital gains, but does exclude non-arm's length income and assessable contributions. This is calculated annually, and the amount is recorded in the annual return at Section A, Item 10. Now, there are two methods to calculate ECPI. You can see that from that the screenshot on the screen there of that tax return. It is possible to use only one of those methods or to use both during the same year, and we will now take a look at both of those methods. So as we said, two methods of claiming ECPI: the proportionate method under Section 295(3)90, which for those of you ordering actuarial certificates through us, you would certainly be aware of. That is under that section, the requirement for that actuarial certificate from us, and claiming ECPI under the segregated method under Section 295(3)85. So we have these two different methods, and of course there are a number of differences. Looking at the proportionate method first, as we said, you will need to obtain an actuarial certificate from your certificate provider in order to claim ECPI under that proportionate method. You'll essentially, the only thing you require on that certificate is the exempt income proportion, but legally you do have to come to us to get that. And then that ECPI proportion will apply to the assessable income for the year to help you calculate the proportionate ECPI. And that applies to essentially all the fund which is not segregated. So any period of the year, any assets which aren't segregated will form part of that calculation from your actuary for that exempt income proportion. Now, as I said though, it only applies to the assessable income. Non-arm's length income, assessable contributions can't be claimed as ECPI. And I believe we actually had a webinar a couple of weeks ago which looked at this further, but our expense deductibility for certain expenses during the year is also impacted by ECPI, but by that exempt income proportion. But if you are interested, as I said, I think it was a couple of weeks ago now, maybe 3 weeks ago, we had another webinar looking at ECPI and expense deductibility. So that was under the proportionate method of claiming ECPI, but as we said, we have our second method, which is the segregated method. And under the segregated method, you don't need an actuarial certificate, because under the segregated method, the assets are solely supporting retirement phase liabilities. And because the assets are solely supporting retirement phase liabilities, we know that the income from those assets solely relating to pension, solely exempt. Now, to segregate assets, that can be done in a couple of ways. We go into that in a little bit more detail, but not a huge amount. It's not the main focus here. You can have segregation as elected, where you do choose particular assets to support a retirement phase pension account, and therefore you know that the income on those particular assets is fully exempt as segregated. Or you can have deemed segregation, which we will look into. I believe the next slide we'll look at deemed segregation, where a certain period of the year is solely retirement phase pension. You know that the assets for that particular period of the year is therefore solely supporting pension, fully exempt. That deemed segregation is, at this point, I'd say it's not new. It's still, though we do get questions on that from 2017 onwards. That became something we did have to think about. Also, from those changes on 1 July 2017, we had the disregarded small fund asset rule, which does impact on the fund's ability to claim ECPI under that segregated method, which again we will touch on in a little bit more detail soon. And under the segregated method, any CUT events, any gains or losses occurring on those segregated assets will be disregarded. So we have those two main methods as we talked about. And under that segregated method, we talked about either being elected segregated or deemed segregated. Now we will talk just a little bit more about deemed segregation. As I said, it's something we still get questions on. It's comparatively new compared to a number of things. So Let's take a look at that in a bit more detail. So a fund will have a period of deemed segregation during the year when essentially it has a particular period of the year where the fund is solely retirement phase pension. There are only retirement phase income streams. There's no accumulation, no non-retirement phase TRIS for that particular period of time. So we know that for that period, the fund is solely pension, therefore solely pension deemed to be segregated. And as I said, this is relatively new. It was clarified with the 1 July 2017 changes, where we were looking at the transfer balance cap, people needing to commute money. The ATO looked at the segregation and said, well, actually, this is what it should have always been, where any period of where the fund is solely pension is segregated, but we understand that's not how the industry has been doing it up to that point. So while we're saying this is how it should have always been, we're actually not going to look into that in more detail pre 1 July 2017. We're not going to use any of our resources to follow up on funds and try to catch that. But from 1 July 2017 onwards, this is how it has to be done. From 1 July 2017 onward, any period solely retirement phase is deemed to be segregated. And as we're saying here, it is any period of time. So that does mean that a fund can have multiple periods of the year where it's deemed to be segregated, and then multiple periods where it is unsegregated, which does certainly add some complexity to these calculations. But unfortunately, it was a requirement there. There was no choice when this change first came in. So we did have funds needing to put in a bit more work to try to calculate ECPI. You couldn't just treat the full year as being proportionate anymore. But that did actually change from up until 30 June 2021. It wasn't that choice, it was that question of fact. But then from 1 July 2021 onwards, we now had a choice. Choice, I think, again, there's a little bit more detail later on, but the choice essentially going back to how it was, where you could treat the fund as being proportionate for the entire year instead of having to have these periods of deemed segregation. Again, introduced to try to, I guess, make things a bit simpler for people instead of having to have those periods of deemed segregation, though the introduction of any sort of choice does in and of itself create some complexity there, because now we have to analyze the options under those different choices, but we'll again look at that in a little bit more detail soon. So we can see a fund here, fund which has deemed segregation. As we talked about, this one here, we see the fund start of the year has that period of accumulation and retirement phase pension, but then partway through the year becomes solely retirement phase pension, deemed to be segregated, comes out of a segregated period, again, mix of accumulation and retirement phase pension, and then back into another period of deemed segregation. And as I said, create some complexity there for the funds. You essentially have to work out when income is earned, make sure it's applied to the correct period, possibly some issues with deductions as well, depending on what those deductions are, exactly how they apply to the separate periods may change how those calculations work as well. So just added some complexity for these sort of funds. But we see here, this is, as I'm sure again many of you are aware, doing an Accurium certificate application, what you would see on our website. And as this is for the 2024 financial year, there is also that ECPI choice option where this fund does have the choice to solely use the proportionate method. But as we talked about earlier, this is our deemed segregation, but we did say there was another rule which came in 1 July 2017, which was disregarded small fund assets, which also impacts on the fund's ability to claim ECPI, whether it will be using the segregated method or not. And it is also, like deemed segregation, something that we still do get questions on. We still have people not entirely being aware of those rules. So we'll just take a look at that quickly as well, just to do a quick update on how those rules work. So, disregarded small fund assets. So, as we said, introduced 1 July 2017 as part of all those other reforms, and it is essentially an annual test that the fund does, which then determines whether the fund is eligible to have segregation during the year. Now, it doesn't necessarily mean that the fund has any segregation, just that it is eligible to have it. And that is, again, something we do get asked a lot. This test doesn't tell you have segregation, just says the fund was allowed to have it. It may not have any during the year, so this test may not be applicable for a number of funds. It won't matter whether they pass this test or not, but it is still something you need to look at, and for funds where it is applicable, you need to make sure you are doing it correctly. So, as we said, it was a test that you do each 30 June or based on the prior 30 June details. And to this test, to work out if the fund has disregarded small fund assets or not for an income year. For the income year you're doing, you look at the prior 30 June, and as at that 30 June, you check if there was, first, any member in retirement phase with a total superannuation balance of more than 1.6 million. A couple of things with that. First off, they just have to be in retirement phase, not specifically in the SMSF, just have a retirement phase interest in any fund. And secondly, we do note that 1.6 million, that is specifically 1.6 million that is set in the legislation. Even though it came in at the same time as the transfer balance cap, which was 1.6 million, that general transfer balance cap has of course been indexed, is up to 1.9 at the moment, but the 1.6 million for the disregarded small fund assets hasn't changed. It's specifically that 1.6 million amount. That is still the same amount you use for this test, whether you're doing it for the 2024 year or you're looking at the 2018 financial year. So that first part of the test, then the fund does need to have a member in retirement phase at some point during the year. If there is no member in retirement phase at any point during the year, then there's not really any point of doing this test because the fund is not claiming any exempt income. It has no retirement phase pension, then it's all non-retirement phase and would just be fully taxable for the year. So of course you need someone in retirement phase pension for the year. And the final part of that test there is the SMSF is not solely in retirement phase for the entire year. And again, another thing to note about that is that that part of the test does depend on what financial year you're looking at. So for 2018 up to 2021, that part of the test for disregarded small fund assets was not there. And we did see for those years, you would have some funds in a situation where they were solely in retirement phase for the full year, so 100% tax exempt, but they still met these conditions for disregarded small fund assets and therefore had to get an actuarial certificate. And it doesn't make a lot of sense. The fund is 100% pension. You can see it should just be fully exempt, but still had to get an actuarial certificate from us. There was talk at the time about that, and eventually 2022 we saw that extra part brought in to say, well, if the fund is solely retirement phase for the full year, you don't have disregarded small fund assets. It doesn't matter if you meet those other conditions. There is some member with more than 1.6 million and a pension account at the prior 30 June, the fund won't have disregarded small fund assets. Is still a little bit of a grey area in regards to that. Certain situations where money may come in to accumulation and go out on the same day. So that does still create some questions for those funds. Our understanding in those situations where say a member makes a contribution on the same day converts it to pension, so then the fund is still pension for the year. With how it's worded though, it does say the SMSF is not solely in retirement phase over the full year. our stance is that even though the contribution is converted to pension on the same day it comes into the fund still can't claim to be solely retirement phase for the full year. So unfortunately, in those situations, the fund could still have disregarded small fund assets and need the actuarial certificate, even if it was then going to be 100% tax exempt. But yeah, as we said, those are the rules to determine if the fund has disregarded small fund assets, and you do need to do that each year because obviously the situation of the fund can change and it can go in and out of having disregarded small fund assets each year. And if the fund has disregarded small fund assets, as we said, it must claim ECPI using the proportionate method, which means coming to us and getting that actuarial certificate. But if it doesn't have disregarded small fund assets, then it can have segregation. It now can have a period of deemed segregation or elected segregation during the year, but it doesn't necessarily mean it has any. As we said, it may not be. For a lot of funds, this test won't really matter. It won't change anything, but other funds which look like they may have segregation need to make sure they do this test to make sure they are claiming things correctly. Right, so we're talking about disregarded small fund assets. And yeah, the changes from 1 July 2017, deemed segregation, disregarded small fund assets. We have had another change. This one is a bit, a little bit after that though, from the 2022 financial year. We touched on it a little bit earlier. And this was that choice of ECPI method. So we said before, how funds before, when they had a period which was solely retirement phase, most of the time the fund would just be treated as proportionate for the full year. You wouldn't treat those specific periods as deemed to be segregated, which then changed from 1 July 2017, where the ATO said, no, this is how it has to be done. But then from 2022 financial year onward, the ATO went back and said, actually, you know what, we're going to give you a choice now in that situation to either use the new approach where you have deemed segregation, or actually go back to what it was pre 1 July 2017, where the full year is just treated as being proportionate, where you just get the actuarial certificate covering the entire year, and that 1% would apply to all the income. Now, for a fund to have this choice, to be eligible to make the choice, it does have a few conditions that it needs to meet. First off, as we said, it needs to be for the 21-22 income year or later. From 2018 to 2021 financial year, there is no choice. Any period of deemed segregation has to be segregated. So it needs to be 2022 financial year onward. The fund can't have disregarded small fund assets, as we've just talked about. A fund with disregarded small fund assets can't be segregated. It has no choice. So the fund, and in this case, a fund with disregarded small fund assets has to use the proportionate method for the entire year. So there wouldn't be any choice there. So no disregarded small fund assets. The fund does need a period of the year where it was solely retirement phase, but not the full year. So again, it would need to have a period of deemed segregation to make that choice on. But if the full year is, again, solely retirement phase pension, as we said, then the fund is segregated. So segregated for the full year. So no choice there. And finally, no defined benefit pensions in the SMSF. The calculations for SMSFs with defined benefit pensions are different to funds which just have account-based market-linked pensions. And for those funds with defined benefit pensions, that this choice isn't applicable. But as I said, as long as you meet those 4 conditions, then the fund does have a choice, and it can either treat those periods as deemed to be segregated, which is solely retirement phase pension, or make the choice and just treat the full year as being proportionate. This ECPI choice, though, it is a choice from what the name says. So if you do meet those conditions, the fund has a choice. You need to specifically make a choice. If you make no choice, there is a default approach, So as we see here, the default approach, if no choice is made, is to apply the methods that are from 1 July 2017 onward that the ATO has said, where any period which is solely retirement phase is deemed to be segregated. So you make no choice, you are going to have any period which is solely retirement phase as segregated, then any other periods which are that mix of retirement phase and accumulation, or accumulation as being proportionate. And so your fund would be using both methods to claim ECPI, the segregated and the proportionate approach. If you don't want to do that, you do want to treat the fund like the pre-1 July 2017 method, where even if it has a period which was solely retirement phase for the year, but not the full year, and you want to treat the entire year as just being proportionate, you don't want any segregation, that specifically requires the trustee to make that choice. The trustee has to choose the fund to be proportionate for the entire year. In that case, as I said, you just get the actuarial certificate, covers the entire year, no dual methods of calculating ECPI there. As we say, that is a trustee choice. I guess exactly how you set that up in your practice is up to you, about how that choice is made, whether there is some default approach that the trustee selects, but there has to be some sort of trustee input on that. So that is a look at ECPI, which actually went a bit longer than I intended. So we'll now on to the second part of our presentation today, though, which is failing the minimum pension payment requirements. So as I said, it's something we do see a lot for funds applying for their actuarial certificate and claiming ECPI. Looking at these requirements, I think we all know for the most part the basic minimum pension standards that the fund needs to comply with. Must make a payment at least once a year, and partial commutations from 1 July 2017 can't count as a pension payment anymore. They are just a lump sum. Once you start a pension, you can't increase the amount there. You can't increase the capital with contributions or other rollovers. It's only income allocated to that account which can increase it. When a member dies, their pension can be transferred to a beneficiary. You cannot use the capital of a pension for borrowing. If you fully commute the pension, you must make a minimum before that. In most circumstances, there are a few situations where you don't need to. And before partially commuting, this is one which every once in a while we do have some people are getting a bit confused on. So before you partially commute a pension, you need to make sure you have sufficient balance left in order to make pension payments, if you haven't already done so. But remember, just a partial commutation doesn't change the required minimum. So you start off a pension at 1 July of $1 million, then halfway through the year you commute 800,000 of that back to accumulation, but the pension is still going. The minimum is still what was calculated based on the 1 July balance of $1 million being there for the full year, because the pension is only partially commuted. That doesn't prorata anything. It's only prorated if it's either starting partway through the year or fully commuting partway through the year. So yeah, we do just every once in a while we'll see people with a bit of confusion on that. So just a good thing to remember there. So those are the requirements for a pension, and you need to make sure you meet those to get those tax concessions. That's one of the main things we want for those members who can now draw a pension is those concessions in the fund. But unfortunately, as I said, we do see people failing those requirements a lot of the time, and the one we're going to be focusing on is not paying the required minimum. And when that happens, there are a few different consequences of that. So your income stream does cease at the start of the year for tax purposes, so you lose that claim to ECPI for the year. That interest, as I said, is now contributes to the taxable proportion, and so lose that ECPI. Any payments which were made from that pension are now treated as essentially lump sums from accumulation. While the pension does cease on 1 July for tax purposes at the start of the year, or if the pension is started partway through the year on that commencement date, for TBAR, the TBAR requirement for that commutation is actually done as at 30 June. So at the end of the year, instead of at the start, where it ceases for tax purposes, and then that income stream now needs to be recommenced in a future year in order to start claiming ECPI again. Essentially the same rules. One thing I didn't touch on, just remember TRIS. TRIS has essentially the same rules, but it does have, of course, a 10% maximum if the member is in non-retirement phase. And if you exceed the maximum, there isn't really a lot you can do there, and it can create a lot of trouble for the fund. So you want to be very careful that you are not exceeding the maximum for the TRIS or underpaying the minimum. Paying some but not the minimum is almost just as bad as overpaying the TRIS. So you do want to be very careful of that. But otherwise, these same rules apply to TRIS in retirement phase and to market-linked pensions as well. Now, underpaying though, there is, you do have an option, even if you do fail those minimums, you don't pay the required amount. There is still the possibility of the fund claiming exempt income, but that does require you to use the Commissioner's General Powers of Administration, that exception where even though you haven't failed the minimum, you still can claim ECPI. Now we can see all the requirements on the screen. I won't talk through them all, just in the interest of time, at least on this page. But yeah, you can claim it, but there are a few different conditions you need to meet there. You need to apply to the Commissioner, make sure you're meeting these conditions, spell them out, and then you'll get that approval back as long as you do meet these conditions and they are happy that that these are met, that you can still continue to claim ECPI during the year. Now, if you are doing that, when you apply for the actuarial certificate, you do need to have already obtained the concession and the approval first before getting your actuarial certificate. If you haven't met the minimums and we see that, we won't complete the certificate based on the minimums being met, based on that pension still being eligible for ECPI. If we don't see that application and the approval that the fund is going to be able to claim ECPI for the year. Now that is though if you are applying to the ATO, there is the option to self-assess that the underpayment for the fund, and just instead of having to actually apply for it, you can just use it essentially. To do that, you still need to meet basically all the other conditions than if you were going to apply, but there is some very slightly adjusted conditions here in that the underpayment needs to be only small, so it can't exceed 1/12 of the required minimum. They've set up there, obviously people have monthly transactions, and for some reason their 1 month doesn't work properly, they can then use this self-assessment. And you also kind of previously applied that self-assessment for another year. So if you do meet all those conditions and those couple of extra ones, you can self-assess that. In that case, when you're applying for your actuarial certificate, obviously you're self-assessing it, you don't have anything from the ATO, so you don't need to provide anything like that to us. But in either situation, you do, as part of those conditions to claim that exception, you do need to have made a catch-up payment or treating a payment from the current year as being made in the prior year to catch up on that underpaid amount. And that payment is treated for all intents and purposes as happening in that prior year where you didn't meet the minimum. So if you're applying for an actuarial certificate, you need to make sure that you also include that payment, because that payment is treated essentially like it has happened in the year the minimum wasn't met. So you want to show that payment as occurring on the 30th of June. And that's whether you are applying to the ATO and having them needing to approve that, or whether you have met the conditions and are self-assessing. Right, so one important thing though, we mentioned it right at the start, we had an update to tax ruling 2013-5, which looks at when a pension starts and stops. And it does have an impact on this particular situation where the minimum pension standards are not met. because we see here the existing approach to that was, as I said, loses ECPI for the year, the minimum's not met, T-bar done at 30 June. And then in the following year, though, most people will just recommence it from the 1st of July. They say the intention is for that pension to continue onwards. So they'll restart it on 1 July and still claim the exemption from 1 July of that following year. And because it's starting on 1 July as well, for T-bar purposes, the commutation happening on 30 June and restarting on 1 July usually match. So there's no change to the overall members' transfer balance account. And the fund is just loses ECPI for just that 1 year, but the following year gets it back again. Now, as I said, tax ruling 2013-5 there was a bit of a change in wording, and because of that change, where it talks about a fund which fails the minimums, and it specifically says the fund can't regain its SIS compliance, and that it does need to stop and restart following all the usual rules of stopping and restarting in order to continue to be exempt. And part of the rules around commuting and recommencing is that you shouldn't be doing that in arrears. There should be at least a request from the member to stop, to commence a pension happening on either that date or a future date, which does, based on this update to tax ruling 2013-5, mean that the fund can't regain its compliance from 1 July, because usually, of course, you realise sometime down the road that the minimums aren't met. You don't realise that as at 1 July of the following year that they didn't pay the minimums for the prior year. You realise that a few months down when you're reviewing the prior year's details. And essentially that means that you can only stop and restart it, that pension, once you realise the minimums have actually not been met. So several months down the track after the year is ended. And it's only from that point onwards the fund regains its exemption. So it now loses the exemption both for the year the minimums have failed, but also in the following year from 1 July up until when they realise the minimum wasn't met and choose to stop and restart the pension. We have a couple of examples here, though I am a bit questionable on time. So we'll go through at least probably the first one very quickly, and then we might even skip the second one. But our example here, just on what we have talked about. So we have two members, Michael and Lindsay of the Galaxy SMSF. 1 July 2023, they both had account-based pension balances, and then we see what those balances were at the end of the year. During the financial year, Michael makes pension payments of $30,600, which is $7,650 each quarter, but he has not met the minimums, that they have been underpaid by $30,600. Maybe somehow those were still halved payments as they have been in prior years, and he didn't actually make enough. Lindsay does make enough. I'm not going to say how Lindsay has made enough and Michael hasn't, but we'll say Lindsay has made $51,200 and has met the required minimum for her. So the consequence of the fund, as we've talked about, is Michael's accounts-based pension will commute for tax purposes. Sorry, give me 1 second. As I said, Michael's pension will cease for tax purposes on 1 July 2023. And as we said, that pension now contributes to the taxable proportion of the fund for the year. The pension payments of $30,600 and not treated as pension payments now. They are lump sums from accumulation. There will be a T-bar on 30 June 2024, so at the end of the year, for the balance on that date of the 1.3 million. And the pension must be recommenced in the 2025 year in order for it to now be exempt. So it can't automatically restart from 1 July 2024. And from a point of view of the fund overall, we see that this fund would have been 100% tax exempt if they both met the required minimums. It would have been deemed to be segregated, as we've talked about, for the full year, claim ECPI solely using the segregated method and not need an actuarial certificate. But now Michael has failed to meet the minimums. His pension, as we said, ceases for tax purposes from 1 July 2023. And that will now mean that the fund is only around 45% exempt for the year. it will claim ECPI using the proportionate method and therefore must get an actuarial certificate. So it's lost 55% of the tax exemption for the year and has that extra cost now of getting an actuarial certificate. Especially depending on the amount of income, can be very serious. That's why you need to be very careful there. I think one final thing before our final example here, just touching on what happens for death benefit and reversionary pension amounts when they fail to meet the minimums. So for a death benefit pension, this is in the year of commencement, it will cease for tax purposes on the date that it is commenced. Of course, the original pension interest, that's fine for the member who's passed away. We know that there aren't any pension requirements for that if it's non-reversionary. So for the original member, up until when they've passed away, when the balance gets paid, that will still be exempt. That's not a problem. But yes, the new death benefit pension fails to meet the minimums. It is still a death benefit pension amount though. A death benefit retains that death benefit status. So even though it has failed to meet the minimum in that year, it must either be recommenced as soon as possible or paid out of superannuation. It still needs to comply with those cashing requirements for a death benefit amount, which is either paid as an income stream to a beneficiary or paid out of super. Reversionary pension is slightly different because we know reversionary pension, when the member passes away, it goes automatically to the beneficiary. It's not a new pension. So if the pension standards, pension payments are met in that year, the pension will cease from the 1st of July. And it does lose the exemption for the full year instead of the death benefit, which only loses it from when it gets started. And then like the death benefit amount, it's still a death benefit amount in the fund though. So again, it must be recommenced or paid out of superannuation. Recommencing should be fine, but you just want to be a bit careful there in terms of, I've had someone ask about it failing a death benefit pension, failing the minimum in multiple years, in which case I'd probably say discuss that with your auditor. It is questionable at that point whether you are complying with those compulsory cashing requirements. Now we do have another example. I'm going to skip that because I've taken much too long. So I will go through to Anthony and have him go through his demonstration. Apologies, Anthony. Yes, I went much too long there. I think you're muted, Anthony. Still muted, Anthony. Nope, sorry. Okay, you might be having a bit of trouble here with Anthony being able to talk to us. I might jump back to the part I skipped, and we'll see if Anthony can jump in once he gets that sorted to try to so we can go through his part here. So yeah, Anthony, just jump in, Anthony, when if you get that sorted, and let me know. So our second example, our second case study here. Well, I think I did hear something.
Can you get my coming through now?
Okay, yes, I can hear you, Anthony.
Perfect. Let me see if I can share my screen. Has my screen appeared fine?
Yes, I can see that.
Okay. Good. Sorry about that, guys. No idea what happened. Morning, everyone, and thank you, Matthew, for for that presentation on ECPI. Okay, so what I'm going to focus on for the next 10 minutes or so are some of the resources and screens that are available on Simple Fund 360 to help manage those pension funds that you have. So in particular, as Matthew alluded to, the minimum pension standards. So one thing that I'll predominantly focus on is the various dashboards in particular. So I've logged into a fund, so you should be able to see the fund dashboard. And one of the cards on there is for the members. And as you can see, it'll indicate straight up once you log into the fund where each member sits in terms of their pensions, contributions, and so forth. So that's sort of the first area that I'd sort of focus you towards. The main screen that you'd go to have a look at minimum pension standards is the pension dashboard. So which is under the member section. For those sort of non-BGL users, each pension account that a member has would be represented by a card here. And as you can see, it will indicate what type of pension it is, who the pension member is, what the minimum that should be taken out for the financial year is, how much they've actually drawn down, and so on and so forth. So for each financial year, you'll have a card representing each pension account within the fund. What's also important here is ensuring that your feeds operate, because if your bank feeds operate on a daily basis, this information would be up to date for you as of yesterday. So that's one of the more important factors as well. Okay, now this is on a fund by fund basis. If you want to also have a look at where your minimum pensions sit across your entire firm, up here where it says account view, you're going into the entity tab. And essentially what this screen shows you is we've got different filters. On the left-hand side, you've got filters for various criteria. On the right-hand side is your full, basically all the funds under your firm. Now, if I scroll down on the left, one of the options here is to see if minimum pensions have been met. So that's under pension status, minimum not met. As you can see, it filtered out the right-hand side. So it says here, I've got about 43 funds which have members in the fund that haven't taken out their minimum. So it gives at least the administrators a quick snapshot of, okay, these are the funds I need to go speak to the trustees and ensure that they've taken out their minimums prior to 30th June. And as I said, feeds become imperative in this because you don't want to be working 12 months behind or after the fact, because at which point you'll have to roll back your pension and that whole ECPI exemption is lost. So it's about being up to date, staying on top of, I guess, each fund and all the members that particularly are in pension phase. If I drill down into each of these funds, it will tell you, where are we? Pension, here you go. So it says 27.8K required as part of them, as in an extra 27.8K is required in order for them to meet their minimum pensions. So again, dashboard is, this analytics page is where you go to get a firm level view. We've got other sort of items as well in terms of total super balance that was mentioned as part of the disregarded small fund assets. If you want to even see in terms of Division 296, which funds are going to be caught up under the 3 million cap, you could just tick it on the left here. That would again filter out all the funds. And the best thing is you can actually change or somewhat, it's pretty much change what each of those filters present. So you can change the criteria as well by ticking on the filter edit up the top. So that gives you, let's just say, a bit more wiggle room in terms of what exactly you want to grab out of our systems. You can also export it, as you can see on the right-hand side, to Excel, which makes it much easier. Cool. The next screen I wanted to show you is the whole actuarial ordering process. So this is done under the members and fund pension policies. So at the end of the year, when you go about ordering a new certificate, you'd come in here, you'd go new actuarial certificate, select the financial year, and go request certificate. We'll show you all the providers that we do integrate with. So Accurium, as you can see, is the first one on the list there. So essentially, once you're ready with 2 seconds, my screen for some reason is flickering, which isn't great. Let me try something. Okay, hopefully that's better. Okay. So the whole actuarial process, select who the provider is, you click next, it'll ask you some personal details to confirm as in who the certificate needs to be sent to effectively. And the next section here is effectively what Matthew spoke about, which is the identification of whether or not the fund has disregarded small fund assets, and essentially whether or not you want to use the deemed segregation method or the proportionate method. We give you the criteria here, so there are the 4 items that you need to check as to whether or not the deemed segregation method in fact can be used. We also show you if each of the members within the fund do in fact have balances over 1.6. So we give you all the information here. You can just confirm. So if you've got over 1.6, we would by default select that you want to use the proportionate method, but we allow you to override as to what option you want to go send through to the actuary. And we prepare the file within the product to shoot through to the actuary provider that you've selected. I'm not going to go through the process. Let me exit out. So I've already got one created here. So effectively what comes back is something similar to this. It will tell you, so in this particular scenario, I've chosen to have the segregated method selected. So you've got a deemed segregation period here. So this is how it would come through in the software. And it will indicate that the fund has opted to use the segregated method. You've also got the questions in terms of the non-deductible expenses. Again, you could use the ATO formula, which will use the tax ruling 9317 to calculate that for you. You could alternatively use the actuary's percentage as well, or you could add your own manual percentage if need be. Once that's all set up, the next stage is effectively going and doing the year-end lockup. So I've already done that. So that's under the compliance screen. You do what we call the create entries process, which that effectively does all your evaluations, your tax calcs, profit allocations, and so forth. It also does, as part of it, preparing the tax return and calculating all your ECPI and non-deductible expenses. Once that's all completed, your tax return gets prepared. If we look at the income section, it will calculate all your income, followed by your exempt pension income. Also, you've got under your expenses, you've got what's your deductible versus non-deductible expenses. In the setup of the actuary, I did select use tax ruling 9317. So at which point it uses the ATO calcs to determine what the general expense as well as the investment expense percentages are. And you could do sort of what if scenarios if need be to identify what gives the better tax position, meaning the better deductions, to give you essentially your best outcome for the client. Once the tax return has been prepared, you can lodge it directly through to the tax office using Simple Fund 360 as well. We allow you to export it out through to Xero, Lodge IT, and yeah, to those platforms as well. Okay, the next one is I wanted to sort of show you to finish off some of the reports that we have on hand as well. So for that, I'm going into the report screen and just sort of 5 reports. Let me quickly prepare these. So it'll prepare a realized gains report. In this particular instance, as you can see, I've got disposals effectively as part of the deemed segregation period, as well as the period that was partly in pension. So the deemed segregation period, as you can imagine, because it is considered to be in segregation, won't be accessible for capital gains. So all that's effectively done as part of that year-end lockup. The create entries report effectively gives you the breakdown of how we do that non-deductible calculation, so essentially based on that tax ruling as to how we get those percentages for both your general expense calculation as well as your investment expense calculation. So that's all. So we try to give you essentially as much as possible in terms of reconciliation as to what calcs happen in the background. It also shows you all the profit and tax allocations as well. So that's what the create entries report would show you. Not going to spend too much time there. But then you have your exempt current pension income break. So again, with the capital gains, it's only made made accessible and then exempted that disposal that sat in the first half of the year. So it's ignored the ones which sat within the deemed segregation period. And similarly, you have these 3 income items as well. Let's just apply the 70% actuaries to tell you, okay, here's your actual ECPI, and this is what will marry up with the tax returns ECPI label as well. Similarly, same sort of breakdown or reconciliation for your non-deductible expenses as well. So it will bring through all the expenses that the funds incurred and apply that expenses percentage, or essentially that investment and general expenses percentages, and effectively reconcile each label of the tax return in terms of how it came about with those amounts. Something else that we do as part of, I guess, what you could use also as part of your conversation for the next financial year with the trustees is this projected pension calculation report. So as Matt sort of mentioned many times, it's about meeting those pension standards, or the minimum pension standards rather. And we try to actually project out to the next year as well, and provide a report as at 30th June of this year. So they're having that conversation early as possible, going, all right, trustees, here are what you need to be taking out for next year. These are the amounts. Make sure you plan so and take those minimums out, because as you know, if not, you lose your exempt pension status. So yeah, just wanted to run through some of those reports. I know we're running out of time as well. That's effectively what I wanted to cover off, guys. So happy to pass over back to Matt to see if we have any questions. And I apologize for the technical issues as well.